Welcome to Going Long with FCLT Global, the podcast that dives into the world of long-term investing and strategic decision-making, hosted by Sarah Williamson. Going Long features thought-provoking conversations with some of the brightest minds in finance, economics, and business today. Each episode will bring you exclusive interviews with renowned executives, investors, and experts who are driving change in the world of finance, getting their unique perspectives and uncovering strategies that have shaped their success. Whether you're an investor, a business leader, or simply curious about the forces shaping our global economy, join us as we explore the power of long-term thinking. This is Going Long with FCLT Global.
Welcome to the FCLT Global Going Long podcast. Today, I'm pleased to be with Connor Teskey of Brookfield. Connor is the president of Brookfield Asset Management, and he's also the head of Brookfield's renewable power and transition business and chief executive officer of Brookfield Renewable Partners. In this role, he's responsible for investments, operations, and the expansion of the renewable power and transition business. Connor, thank you so much for joining me today.
Thank you for having me. Pleasure to be here.
Great. So, let's get started with just a little background on you. You've been at Brookfield for quite some time in a variety of roles. You've, along with running Brookfield Renewables, have been president of Brookfield Asset Management. So just give us a little, how'd you get here? What's your path?
Sure. So I'm Canadian. I grew up in Vancouver. I did my schooling in Canada, and then I joined Brookfield 13 years ago. I've been here a while, and I started in Toronto in the private equity group. And one of the great things about Brookfield, and one of the great things I've enjoyed thus far, is I've been able to work in different offices, different groups. So started in Toronto in the private equity group. In 2016, I was asked to move to London and join the renewable power business, and made that switch simply to be a member of a team we were trying to build out here in Europe, and been here for 9 years. The roles have changed, but I've stayed here based in London.
Great. That's great. Well, we are sitting in London, and we are sitting here talking about this on the first week of April, right after Tariff Gate or Liberation Day or whatever we want to call it. It's still early days in terms of how the tariffs will evolve and how policy will evolve. But as you think about your business, which is mostly investing in long-term assets, with so much short-term market turmoil, how do you square that circle? How do you balance those two?
Sure. So maybe come at that from a few different directions. There are some mega themes around the world. I'm sure we'll talk more about them today, whether it be digitalization of the global economy, decarbonization of the global economy, deglobalization of the global economy. Those trends are going to continue for years and decades to come, regardless of last week or yesterday or tomorrow's announcements. To react to the events of the last few days or the last week, what impact do we think it's going to have? The tariff announcements are a supply shock, but they're a supply shock like many other supply shocks we've had around the world in the last 4 or 5 years, where it was disruptions to shipping lines, whether it was pandemics, et cetera. And generally, supply shocks, they will lead to short-term negative impacts on the economy, but those are short-term. But what they do lead to long-term is very significant investment in resiliency and redundancy of supply chains around the world. And that will create a large and growing and greater demand for some of the real assets that long-term investors seek to invest in.
And long-term investors right now are really trying to decide which of these things are the announcement of the day and which are really fundamentally changing. So as you think about supply chain shifting over time, I think we sort of know the direction of travel there. But companies are struggling with where to put that infrastructure. Yeah. How do you think about that? Is it optionality and being able to do things in different places? Is it not having all your eggs in one basket? Is it picking a winner and just sticking with it? Like how do you kind of think this through in this environment?
Hey, you started with optionality. I really liked your second one, which I almost describe it as insurance. The world went through a period, and obviously this is a gross oversimplification, but the world went through a multi-decade period of focusing almost purely on efficiency. And efficiency is great. It can lead to the absolute lowest cost production of a good or service, but it doesn't have any resiliency or redundancy to any sort of disruption. And when you get those supply shocks like we've seen over the last 4 or 5 years, let's be clear, we're not going from one end of the spectrum to the other end of the spectrum, but we are simply seeing an environment where whether it's governments, whether it's corporates, they're increasingly looking for a greater amount of resiliency in their supply chains. And we actually see this in two places. There's one more talked about than the other. This theme of onshoring that everyone talks about, the production of critical goods and services at home, that generates a lot of publicity. It requires a lot of global investment. The other one that flies a little bit under the radar in our minds is the largest, greatest, most profitable, fastest growing corporates around the world. Well, these are the best companies the world has to offer. They don't keep tens or hundreds of billions of dollars lying around to build some redundancy or resiliency in a supply chain once in a generation. And therefore, those corporates are creating a demand for long-term investors to provide the capital to create more resiliency in those supply chains. That's the other impact of deglobalization that we think is not getting as much headlines as that overarching onshoring theme.
Almost the ability to, if you will, rent versus buy in terms of not just being stuck in one place.
Rent versus buy or provider plus one or provider plus two in terms of alternatives. And it doesn't need to be because of geopolitics. It can be because a ship gets stuck in a canal or there's a disruption in a manufacturing facility. We're just seeing a global demand for a bit more resiliency at the expense of a bit of efficiency. And that's different than what we saw maybe 5 or 10 years ago.
Right. As you said, the pendulum really went one way. And we learned that lesson in COVID.
Yeah. And we're not swinging.
Right.
We're not going the other end of the spectrum. We're just going back towards the middle a little bit.
Yeah. Right. So you talked about 3 mega trends. One is deglobalization. One is digitalization. So maybe we can come to that one next, and then we'll come back to decarbonization. But in terms of your business and the digitalization or the use of AI, clearly that is making things more efficient, even if they're more resilient. But how do you, everybody's trying to figure out how it's going to really change their business over the next 2, 3, 5, 10 years. How do you see that here?
Yeah. So I'll make 2 comments there. When we think of digitalization and how we view that opportunity, we very simply view data as a commodity. Data is the fastest growing commodity around the world, and it needs to be transported, stored, and processed just like any other commodity. And the investment in the transportation, storage, and processing of data is a very large opportunity because the growth in that commodity is exponential on a level that we've seldom seen. In terms of the impacts of AI and where we are seeing it is very simply, it is a huge driver of productivity enhancement. And that is so important in so many places around the world right now where growth is stagnating or growth is slowing, but governments do not have the balance sheets to invest to support that growth. And that's really creating the need for 2 things. One, either productivity enhancement to drive that growth improvement or private investment to fill that void that government investment is leaving behind. And we see both of those things creating fantastic opportunities for not only the use of AI within businesses, but also investment opportunities to support the growth of AI going forward.
So some people have argued that the growth in demand for data and the data centers and so on is overhyped, that it is sort of like the telecoms of whatever it is 20 years ago, right? When everybody needed cable to everywhere.
Yeah.
What do you think? You've talked about exponential growth. Are we catching up? Is it we're going to use less? We just got to build it.
So we subscribe to that theory, and I'm going to get the quote wrong, but people overestimate the impact of things in the short term, and they underestimate the impact of things in the long term. I'm sure I didn't get that entirely quoted perfect, but we do view AI as very transformative. And while we do not know the exact path it will take to getting there, we view AI kind of like the internet. At the beginning, people who used it were first movers, but fast forward 10 or 15 years, everyone uses it and they don't even think that they're using it, but it makes the world more efficient. Everyone uses email. Everyone, interacts on their phone now, and we don't even think about it. We see AI integrating into businesses, personal consumption like that over the next 5, 10, 20 years. When it comes to the demand for AI, I think there's two things that are unique about AI versus maybe that example from 25 years ago. Again, oversimplifying, but 25 years ago, the way to win in the internet revolution was to have better code. And that meant you needed, again, oversimplifying, but a few people with a few computers and some excellent minds, and you could create a market-leading product. The difference about AI is it requires significant amount of capital-intensive infrastructure to be used. You need data centers. You need the power that supports those energy-consumptive data centers. You need to reinforce the grids that move the power to those data centers. These are investments of tens, hundreds of billions of dollars to support the growth of artificial intelligence. And because of that, one of the differences between what happened 25 years ago and what happened today is the growth is being dominated by market leaders that have that access to capital to support the build out of that backbone. So investors like us and many of our peers around the world that are investing in digitalization, we are not investing on spec. We are only investing in those hard assets that support AI when there is a long-term contracted offtake on the other side. And that dynamic is very different from the one from 2.5 decades ago, where it was a capital light revolution. This is a very capital intensive resolution. And we think that greatly diminishes the chance of overbuild, because there always needs to be a demand provider on the other side. The second thing is, again, with these technologies that are going to have an impact in the near term and a significant impact in the long term, they never grow linearly. It would be crazy to think that they would. And over the last 6 or 12 months, there's been a number of headlines where people have suggested, oh, is this growth overhyped? What was the forecast too aggressive? One of the most important things is, as AI continues to get developed, it would be very natural for it to become more efficient, to be produced in a more cost-effective manner. And every time that happens, all it means is AI is going to become commercial and functional in a greater amount of use cases. The efficiency in AI is going to drive greater demand in AI. We see very little chance of overbuild at this point.
Okay, that's very helpful. The demand is essentially insatiable at this point because it's the capabilities are just increasing.
Yeah, you're absolutely right. And sorry to cut you off, but the one thing, without being too pointed on this fact, is there were lots of demand forecasts for AI that were very, very, very robust. There still are. The reality is that demand was not going to be the restrictor on this. Supply was going to be the restrictor. And even if you were to haircut some of those demand forecasts quite meaningfully, supply is still, the demand still outweighs the supply. The supply demand imbalance is still in favor of those that can provide the necessary inputs to enable the growth of AI. And until that changes, which is very tough to see in the short or medium term, again, there's no chance of overbuild.
Yeah, that's very helpful. One of my, you mentioned that who knows where AI is going to lead, and I think that's one of the things we all have to really keep in mind right now. And one of my favorite analogies about that is when the elevator was first invented, it was to get you from the ground floor to the fourth or fifth floor. But what it led to was a city like this, right? And
right.
So,
yeah.
How do you get from there? What's the equivalent? Yeah.
Right.
Yeah.
So interesting.
Yeah. Okay. So that is it is a capital intensive endeavor. So is decarbonization and renewables. So let's talk a little bit about that. You have spent a lot of time on this and invested a lot of capital in it. Politically, it goes one way or the other. But what are the long-term trends here in terms of renewables?
Sure. So sometimes people are taken aback when we say this. We're very fortunate to be the managers and custodians of one of the largest renewable power portfolios around the world. And people are shocked when we say renewables haven't grown exponentially over the last 5 to 7 years because they're clean. They've grown exponentially over the last 5 to 7 years because they're cheap. And they have grown because technology advances have made renewables the cheapest form of bulk electricity production in almost every major market around the world. And that is true regardless of ESG sentiment, regardless of government policy, regardless of tariffs or subsidy regimes. And it doesn't matter if it's widget manufacturing or service provision or electricity production. People will always take as much of the cheapest alternative before they turn to a secondary source. And that is what is driving the growth of renewables around today. Now, that is not in any way to suggest that decarbonization hasn't been a meaningful tailwind. Of course it has, but the primary driver has been economics and capitalism, and those tend to not adjust so much with sentiment or regulatory change. We spoke a lot about digitalization, and that layered into speaking about decarbonization. One of the things that's been very interesting about electricity production in general is we went through a period of 20 years where electricity demand essentially didn't grow. GDP growth, which drives electricity demand, was offset by energy efficiency. And at some point, 5 or 6 years ago, not due to AI, but due to broader electrification of industry, of transport, of the global economy, for the first time in 2 decades, we began to see a long-term runway for electricity demand growth. That was only accelerated and enhanced by this new incremental driver of AI, which is very, very energy consumptive. And that is what is driving the growth of renewables around the world today. Electricity demand is going up, and what is going to be the largest servicer of that growing demand? The cheapest option. And there is not a government or region around the world that wants to deny its people or its country access to cheap electricity. That is a competitive advantage on a global scale right now. And when you think of global objectives of low-cost electricity, of energy security, you don't need to import the sun, you don't need to import the wind, and decarbonization. Renewables are great because they're kind of that gray shaded area in the middle of that Venn diagram. So we continue to see a very robust demand picture for renewables for a very long term into the future. And that's largely being driven by corporate demand.
Yeah, it's just a better technology. It's just a better mousetrap. Yeah.
Exactly.
Yeah.
And not to go down a rabbit hole here, but one of the frustrations spending a lot of our time in power generation and renewables is people want to classify renewables as one thing. It's all renewables. The reality is, if you focus on the lowest cost, most mature technologies, in our minds, primarily onshore wind, onshore solar, battery storage, distributed generation, those are winning on cost. And those are winning on cost today, and they're only going to further cement that position going forward, which is what's driving their growth and will continue to drive their growth.
And the security point is a really important one as well. Yeah, because particularly in a world with tariffs, geopolitical problems, and so on,
you don't need to import an input.
That's right.
And there's another almost underappreciated driver of renewables. We should be clear that the immediate increase in energy demand is great for all production types of energy. It's good for nuclear, it's good for gas, it's good for renewables. For all the reasons we just said, people will fill their boots with renewables before turning to a more expensive alternative. But in this environment where there is growing demand in the short to medium term, the most valuable thing you could have is unused generation capacity. And there are some owners of power facilities around the world that have it, and they are performing very well today because that is very valuable. But that has very limited capacity. The next most valuable thing is power, incremental generation capacity that you can bring online quickly. And the second joy of renewables is they are not only cheap, but they can be brought online much quicker than many of the alternative forms of power generation. So they win on cost and they win on time to market.
Right. You can't build a nuclear power plant quickly.
No. I would be very confident you can build a solar farm that's built 3 to 8 feet above the ground. You can start on 4 sides and meet in the middle. Everything ships in a regulation size shipping container. You can build that quicker than a gas plant as well.
Yeah. Very interesting. And so if you think about, a lot of the assets that you're investing in, maybe you can build it fairly quickly, but they're still long-term assets.
For sure.
They're not, they're not capital light. They're typically not liquid. Many, I mean, some things are, but many of them are not liquid. How do you think about the illiquid assets relative to sort of the need for a short-term return?
Yes.
And particularly in a time of market turmoil,
yes.
Worries about liquidity. Does it just go in another bucket and it's so illiquid that you just don't touch it, or are you worried about any contagion between the illiquid and liquid sides of portfolios?
So maybe come at that 2 different ways. We often get the question less so about liquidity, but more so about short-term versus long-term investment horizons. And we really focus on investing in real assets. And to be clear, that goes beyond infrastructure or power generation. This is real estate. This is manufacturing. This is the production of critical goods and services. Our business, very simply, is about producing strong returns while taking very moderate risk. That is what we live by every day. And when we have that discussion about short-term versus long-term, often what are people worried about in the short term? Let's take the last few years as an example. They're worried about inflation. They're worried about market volatility. They're often worried about if there's an investment trend, can I invest in enough scale in that trend in a short period of time to make it worth my while? By that definition, real assets have actually performed exceptionally well in the short term, even though they are long-term assets by nature. They are an inflation hedge. They provide stability in terms of returns that are somewhat insulated by day-to-day movements in capital markets. And they are tremendously sized market opportunities. And that last point is the segue to liquidity. Make no mistake, owning a real asset or a real asset platform is less liquid than owning a stock that you can get in and out of with the click of a button. But with the rapid growth of, I'll say, institutional investor demand, but in fact, all investor demand for a growing amount of real assets, we're seeing that market get much, much, much more liquid. We would suggest the real asset market is not any more or less liquid than private markets in general.
Okay. All right. That's helpful. There's been, as you've said, there's been more interest in real assets over the last number of years, but it hasn't had the kind of growth that private equity has, for example. So are you not too concerned that people are over allocated? Because I think in the private equity market now, there's a lot of concern that institutional investors are over allocated.
Yeah, in fact, I think we're seeing the opposite. And not to tie it back to the question we just discussed, but if anything, the last 5 or 6 years have really been an incredible case study in the benefit of owning private real assets. They are critical. They perform when GDP is expanding. They also continue to perform in periods of market contraction because they are critical in nature. They act as an inflation hedge. Nobody worried that much about that 10 years ago. It became a lot more relevant in the last 2, 3, 4, 5 years. And I don't think there is much debate that public markets are becoming increasingly volatile. And that is certainly creating a great tailwind for private real assets that perform exceptionally well. They can provide those strong returns with moderate risk over the long term, but they perform much more consistently over that time period, and that has a growing importance in investors' portfolios today.
More of a ballast to that portfolio.
Absolutely. Right. And apologies if this wasn't obvious, but we don't think that's a short-term reaction to anything. That is a multi-decade trend. From 2000 to 2010, people were just dipping their toe into investing in real assets. In 2010 to 2020, that growth accelerated. Now it is mainstream. I think the next leg of it is it's a growing allocation in portfolios. It is point one. And two, it begins, those types of investments increasingly become available to a greater number of investors. Historically, I'll use the example of large private and direct investment in real assets has typically been for large institutional investors around the world. Increasingly now we're seeing it in insurance portfolios. We're seeing a growing allocation from retail investors. We think we are still in the early innings of that growth.
So if you look forward 5, 10, 15, whatever years, how do you think the market's going to be different? Sounds more allocation to real assets, still quite a bit of private, public sort of doing their thing.
Public's always going to be there. It's very important. We think the market needs a balance of both. We do think a growth in the private markets is logical. The other thing that we feel very strongly about is the breadth of investors that will look to invest in private assets will increase very dramatically. Again, I'm going to get the quote wrong, but the typical portfolio, you do X amount of stocks and X amount of bonds. Well, that assumes you can only invest in public markets. We're increasingly seeing more and more ways for more investors to access the private markets. It's not going to be a 60-40 split of only publics. It will be a split between publics and privates for all investors.
Great. And as you look forward, maybe you've talked about many of them already, but you are a long-term investor. You do look at these trends over long periods of time. Is there something that we're not seeing besides, what happens in the next, demographics, for example, are always very hard to invest in. They always sneak up on people. The private credit market has been very different over the last 10 years, say, than the prior, and could be very different again. Are there, if you're sort of predicting what's going to be interesting over the next few years, what do you think? Yeah.
Can I give you a trend that's happening within our portfolio that we find incredibly interesting, a little bit counterintuitive, and we don't see it slowing down, which is, I don't have a specific stat to back this up, but maybe from the period 7 years ago to 10 years ago, our business was primarily a buyout business. We would buy 100% of a business. We would look to operate that business better over the life of the investment and then seek to sell it. Over the last 4 or 5 years, a growing amount of our investment has been in partnerships, but in partnerships with leading corporates and institutions around the world. These are the largest, most profitable, fastest growing companies around the world that have tremendous access to public capital, and yet they are still choosing to partner with private capital to fund the growth and opportunities within their platform. And it's not across any specific asset class. We helped Intel, we supported half the build out of one of their semiconductor facilities in the United States. That was $16 billion, our half. Intel has lots of access to capital, but still they chose to partner with private capital. We have a clean energy partnership with Microsoft, debatably the greatest corporate in the entire world, and yet they're still looking to partner with private capital to build out the supply chain to support the growth opportunities in front of them. We've done large partnership transactions with Deutsche Telekom, and we continue to see a long pipeline of these opportunities of partnering with incredible businesses around the world that have great access to capital, but are still choosing to partner with private capital to capture the growth opportunities ahead. That's been happening within our business for 3, 4, 5 years. We only see it accelerating going forward.
Yeah, and that makes sense because these great companies have certain skills. They're technology companies or telecom companies or whatever they are. So it's probably, it may not just be the capital, right? It's the expertise.
You nailed it. You're absolutely right. It's not just, it's two things. One, it is not just the capital. It's having not just a capital provider, but also an operating partner in capturing these objectives and building out these initiatives. The other thing, and this ties back to some of the huge themes we talked about earlier, we don't mean to say this flippantly, but these trends of deglobalization, decarbonization, digitalization, nobody disputes them. But the scale of these trends and the capital requirements to capture the growth opportunities in these trends are so significant that, quite frankly, they outstrip what is available from governments, and they outstrip what is available from the public markets. And that is creating a very large and attractive opportunity for private capital. So some of it is the capital, but you're absolutely right. It's the operating expertise and the ability to be an operating partner as well as a capital provider.
Right. It's not just the money.
Yeah.
Well, thank you so much for your insights. I think that your business is one of the ones that is sort of, it classically typifies the short-term, long-term trade-off because you've got such long-term assets in some ways, an ability to focus on those things. Obviously, we very much appreciate your being part of focusing cap on the long term, and you can see why here. But I really appreciate your insights and your time and ability to try to look beyond today's headlines to what's really going on. So thank you.
Well, thank you for having us. It was great to be here.
Great.
That concludes another episode of Going Long with FCLT Global. We hope you enjoyed our conversation today and encourage you to continue exploring our resources and research at www.fcltglobal.org. If you enjoyed today's episode, don't forget to subscribe, leave a review, and share with others who may find value in Going Long with FCLT Global.